Are you as excited as I am to talk about the California Prop 19 death tax? I feel like I need a sound effect for that. I should have added one in. I didn't. Today's a big day. We're going to be talking to our trust attorney extraordinaire, Kevin Snyder of Snyder Law. We're going to cover Prop 19. He's going to give us a quick overview of the big, beautiful bill and some changes he found there. We got Michelle in the background, keeping things clean. Make sure you post your questions. We're diving deep today into Prop 19 and maybe too deep. I don't know. You let me know, but post your questions and then you can always follow up after. Remember, I can't give tax or legal advice. Kevin certainly can, but I can't. So without further ado, let's bring in Kevin. There he is. There's my buddy, Kevin.
Hi.
Good to see you. So Kevin took a nice long trip, so he is happy and relaxed and well rested. He's can spend tens of hours with us. He's so relaxed, right? Well, maybe not. Maybe
Well, look, no big bags under my eyes. We'll see how long that lasts.
Exactly. It's going to unwind very quickly. Hey, Michelle in the background, keeping things clean. Can you enlarge us so we fill the screen up? I know there's a button I need to push, but I can't find it right now. So, Kevin, you've been an attorney for a while. You've done lots of fun stuff. Fell in love with law in high school, with doing a mock trial. You've done criminal law. You did real estate law shortly, and now you're doing trust law. So, first off, number one, thank you for being here. Number two, big, beautiful bill. I know there were some changes potentially to estate planning, but just give us a very super fast overview on some of the changes in the big, beautiful bill related to estate planning and et cetera.
Sure. So, depending on where you sit, it might not be so beautiful. It certainly is big, and big in the sense that it covered a lot of ground and it has a significant impact. And it's one of the larger tax bills in recent history, actually, since the Tax Cuts and Jobs Act back in 2017. So this is kind of a coda to that big bill. Here, the big call outs right now, because there's a lot in this bill, Christian. There's a lot, and lots of people, lots of experts are going to be dissecting it in the upcoming months. And I already have gotten emails from other associations. Come to the webinar in September, when we're going to be talking about how the impact. So, a lot of things, of course, it takes time to decipher and see how the chips fall. But some things are very definitive and are important. We can call them out right now. The two big items that I would focus on with clients already, as you imagine, I come back from vacation, I'm already getting hit up with questions from clients about how does it affect me. One is with the estate tax, and the other is with Medicaid. And of course, if you're paying attention at home with the newspaper, a lot of conversations about Medicaid. Here in California, our Medicaid program is called Medi-Cal. So I'm going to call it Medi-Cal. That's Medicaid in California. But first, those are the two big call outs. Estate tax, we have bright line clarity now. There's not going to be the sunset that people may have heard about at the end of the year. It is, as of January 1, $15 million estate exemptions per person. So what that means is if you are an individual and you have an estate that's less than $15 million, then your heirs don't have to worry about an estate tax. If you're a married couple, then it's $30 million. Your heirs don't have to worry about a estate tax. And those numbers will fluctuate upwards with inflation over the upcoming years. There's no sunset in the future as a part of this bill. So it's not like, hey, 5 years from now, we're going to have another conversation about it. So they've permanently set the bar really high. So now that brings a lot of great clarity, though, because some people were on the fence. So shoot, I don't know. In January 26th, if I die, there's going to be a huge tax bill or not. So that's helpful, whether, again, depending on where you sit with the tax law and politically, you might like that or not like that. Certainly, if you have a large estate, your high net worth, you like that. So that's helpful. Also helpful is the fact that we have certain income tax brackets. That's clear, because that was going to shift upwards next year. And they said, no, we're going to keep them the way they are. That's good. What was not part of the bill was anything to do with the capital gains as far as step up in basis or doing away with that or anything in that regard. So that's all the same. And that's important to our conversation today. We'll get into that later. And the last piece was the Medi-Cal. Again, this is Medicaid. In California, to receive long-term Medi-Cal, meaning that you have a spouse or yourself, you're going to a skilled nursing facility. We call them nursing homes. They to get Medi-Cal to pay for some or all of that. In California, it didn't matter the number of the value of assets you had. There was no asset test or asset restriction as there is in other states. If you go on Google will say, hey, you can't have more than $2,000 in order to qualify for Medicaid. That's true in some other states, not California, and not California currently. But as of January 1, in response to this one big beautiful bill act reducing the number of federal dollars that are coming to the state, all states, California included, California's responded and said, well, we're going to reimpose asset restrictions because they're not going to have enough money to give Medi-Cal to all the people they're currently giving it to. So they're going to have to, that's how they're going to do their budget, is that they're going to do cuts by saying you're no longer qualified. So this is a problem for people that are currently getting Medi-Cal for skilled nursing facilities, that they might not be qualified as of January 1 anymore, or people in the future won't be qualified because of these asset restrictions. So that's the bad news. The good news is that there are strategies we can talk about perhaps another time.
Yeah.
We can overcome that, but that's just something for people to know. There's some urgency around it because not many months before January 1st rolls around.
Yeah, I was actually going to ask you that if you've got some tricks up your sleeve, because by the assets that they're going to be looking at, obviously mean bank accounts. Do they mean real estate as well and
Yeah,
retirement accounts?
that are not your primary residence.
Got
So
it. Okay.
the real estate outside of that.
Okay. And
But
then,
bank accounts, investment accounts, retirement accounts, all those come into play.
okay, good to know. So, like you said, somebody right now who hasn't worried about it is now going to have to worry about it, and they need to chat with you ASAP. So no, I appreciate those updates. So let's dive into Prop 19, and we're going to talk about Prop 19. I referred to it as a death tax. I think people more often think of estate taxes as death taxes. So, what are the three taxes out there, Kevin? Tell me about those. We were talking about
Yeah,
those.
the big bad three that I refer to are estate taxes. Those are taxes the federal government or state governments will impose on an estate after death. So hence that's where classic death tax come from. It's only and it comes after you die, and you're the people that are affected, of course, are your heirs because there's less money that they inherit because the IRS takes their cut or the state takes their cut. California does not take a cut because California does not have its own separate estate tax. Other states like Oregon, for example, Massachusetts, Connecticut, and some other callouts, they do. So sometimes there's like a double taxation. Feds get some and the state gets some. But California, at least we don't have that tax. But
Not yet.
federal. So but again, you have to have be high net worth in order to be concerned about the federal one in
Yeah.
California, right? So that's one. The other one is income taxes. We all know income taxes. So that might be W-2 wage. That could be a rental income from an investment property. So a 1099 comes or a K-1. Or it could be a capital gain. You sold a property or you sold some stock. You have to report that gain. That's all income. And then the third is property tax. Now that is a property tax. There's its own code in California, the revenue and taxation code. But it's monitored by county through the county tax assessor, imposes the statewide code. So that is a tax based on what the county says the value of your real estate is.
Yeah.
And
That's where
that's what that tax is, and you pay that during lifetime.
That's where it gets fun. So to refer to Prop 19 as a death tax, it can change after you die, the property taxes you pay. And that's what we're going to discuss today. So Prop 19, basically since 2021, if you passed away before Prop 19 went into effect, in many cases you were able to keep the family was able to keep the low property tax basis on most, if not all, of the real estate. And after Prop 19 went into effect, there were some benefits, but one of the downsides is the fact that you are going to be reassessed on the real estate that you have. Investment real estate is going to be reassessed to market value. Had this I've seen several, I've had several clients come to me. They have to sell. The property doesn't make sense anymore. I had a triplex in Pasadena, crazy low income. After the reassessment, the income didn't cover the property taxes, let alone any of the maintenance. And the LA County for this one decided that that property was worth over $1 million. We ultimately sold it at 750. It had low rent, severe deferred maintenance, other issues. That's ultimately what the market value was. But good luck convincing LA County of that value
Right.
before it sells. So,
Yeah, it's been a crazy road since 21. We've kind of look back before. It's kind of the idea like before pandemic, right? So before
mhm,
pre-pandemic, life was a lot different, including with property taxes. Not only with pandemic, in 2020, Prop 19 was passed as a proposition, and it went into effect only months later in early February of 2021. So I can tell you that was a crazy time in our practice. Those few months, barely made Christmas that year. We were working around the clock. My kids could tell you the stories. In fact, they could create a trust and recite all the pros and cons of trust and all Prop 19 law at that point because we were working out of our house back then in pandemic. So you ask them about Prop 19, they roll their eyes.
well, and it was tough to even get guidance on it. The law. So what ended up happening, because a lot of people I've talked to since then, they were annoyed at real estate agents in particular because California Association of Realtors was pushing Prop 19. Prop 19 did three things. It allowed a change in, basically allowed you to go from transferring your property tax basis just one time in certain counties in California. If you're over the age of 55, you could do it three times, and it was anywhere in California, all counties. So that was the one that the California Association of Realtors was excited about, and they were talking about. The third thing it did is it set up a fund for fires. The second thing it did is what we're talking about today, is it changed the value. It changed property taxes after someone dies.
Mhm.
That's the one where they look at us and like throw daggers at us, and nobody told us that was in there. Well, I'm like, I mean, not to be rude, but before you vote for something, my advice is that you understand what you're actually voting for. So anyway, I'll get off my soapbox now.
No, you're completely right. That's why, I talk to some clients that have a hard line. If it's in the proposition, I always, vote no because it shouldn't be. We shouldn't be deciding these major things in propositions. It should be through the legislature.
Yeah,
That some people may disagree with that. I'm not saying that that's my position. The hard part is that the propositions are in a big public forum, and there isn't time or room to really discuss them thoroughly uh,
correct.
in that forum. So things like this get missed, and they get sold on the commercials online. I remember them with the firefighters and all that because we were tracking this before the election because we knew of the implications. And so that was the hard part. The other thing that was kind of out there in the universe was this was very high net worth, rich people, Hollywood movie stars were getting away with paying low property tax on very high valued land, which is true. They were paying low property tax on high valued land, but it wasn't just going to be restricted to high net worth individuals. It was for everybody. So that
Yeah,
there was the family that was highlighted had a property in Malibu and very famous actors. If anybody is familiar with the Dude,
Oh yeah.
Family they highlighted in the example in the proposition book that you got back. A bit unfair because that was they were just utilizing the law Prop 58 that which benefited everybody, which
Yeah.
was a parent could die and give their child their home or any other real estate. And not only did the child inherit the real estate, they also inherited the property tax bill, meaning there was no reassessment because there was an exception from a parent to a child. And so lots of people that was, hey, the grandma and grandpa built the house on Balboa Island. It passed down to their son when they died. And now they want to leave it to the next generation. And that was the idea. We're going to keep this property within families because either they're high value properties or they're legacy properties in the sense that it's a great property to have. We used to vacation there, all our memories are there. So whether you're on Balboa Island, I pick on that because we've seen a lot of turnover in these areas where a property is appreciated quite a bit, like Newport Coast, Balboa, Newport in general, Laguna Beach, all those places. But also there's other places. Let's say you have a cabin in Lake Arrowhead. It's not multi-millions of dollars, but if it's been in the family for 40, 50 years, now the property tax is going to jump up quite a bit. So these things affect just movie stars, affect average people.
That's it. At the end of the day, you're right. It's the old cut off your nose to spite your face.
Mhm.
The What's important to understand too. So, and then I want to dive into your example because you have a strategy that folks can use to potentially avoid this. So before Prop 19, you could have your cake and eat it too. So you'd get a step up in basis on the property value, which meant that if you did sell, you wouldn't owe any income tax on that. There was no gain. And then you got to keep the low property tax rate. So it really was cake and eat it too before Prop 19.
That's right. And that's why we were so busy before February 16th of 2021, because we were um, transitioning assets before the law went into effect, so people could have their cake and eat it too. Um, but a point that I want to make, because this is where legal terms confuse people, uh, and sometimes confuse those in the law too. So this cost basis or step up in basis. When we say step up in basis or look up anything online out there, what that's referring to is referring to capital gains and capital gains tax. It's not referring to property tax.
Yeah.
While we're looking at the value of property when we're assessing capital gains or we're assessing property tax, they're two different universes. So the step up in basis is the increase in the value for purposes of calculating a gain, a capital gain. That is still on the books. You die, it goes to anybody. It doesn't have to go to your kid. It can go to your grandkid. It could go to a cousin. It can go to a best friend. Go to charity. There's going to be a tax benefit, and that the gain that would normally be taxed is washed away because the gain is measured at the date of death value. That's still on the books. That's still helpful. Um, that's only transitioned at your death though. So, but that's a separate universe. The universe when we talk, and some people get confused, rightfully, and they say, "Oh, but there's a step up in basis for property tax, right?" No, there's no step up. That's not. We don't want there to be any sort of movement in the valuation of your property for purposes of calculating property tax, because that just means you're going to pay higher property tax, or the owner's going to pay higher property tax. So we really want that value to be lower. The law in property tax land talks about value. They don't use the word basis. They use the word value. When you open your property tax bill that you get from the county, and a little box on the bottom, the yellow box or the little white box inside, it has the numbers of the value. That's your value. They talk about a base valuation. So
Great distinction. Thank you for breaking it down like that. I
you
love that.
confuse the topics.
Yeah, exactly. That's a perfect way to look at it. So basis versus value. I love that. I'm going to steal that. I'm going to use that in future videos because I've done a bunch on Prop 19. So I want to share the slides you have here, but I also want to make a distinction for your primary residence under Prop 19. So let's say your parents are living in a house under Prop 19, and that's their primary residence. If they pass away and one of the children, any of the children, move into that house and make it their primary residence, you are going to avoid a change in property tax on some level. And what that means is basically you'll get $1 million. It's actually now 1,044,000 and change
Yeah.
that will be added. There's no easy way to do that. I feel like I need a board, but basically you won't have any increase in property taxes on that 1,044,000. So to put numbers to it, let's say the house is worth 200,000, or they bought it for 200,000. They pass away. It's worth 1.244. That house will not have an increase in property tax value because of that 1,044,000 buffer. I know Kevin's like, did he do his numbers right?
Mhm.
I did.
You did the number. For people, just remember, this is only in the situation where this is the parents' primary residence that they were living in at the time that they died, and
Yep.
within 1 year of death, at least one child has moved in and claimed that as their primary residence by filing a homeowner's exemption. So that if and the 1 year is strict, and it is measured by filing of the homeowner's exemption, which is that form that you get that says that if you fill this in, you're going to get basically $70 off.
Yeah.
That's the homeowner's exemption. You got to fill that out and file it within that 1 year in order to secure this. If you don't, counties have been very strict and say, well, you otherwise meet it, except that you filed this too late. So sorry, we're reassessing. So it's a
So I found this. This is actually the BOE, Board of Equalization at California's level, and this talks about those very things that you're talking about right now. Where it talks about the deadlines. You have homeowners exemption, strict 1 year, file the claim within 3 years, or before transfer to a third party. So you can't like wait 2 years, sell it, and say, "Oh shoot, I forgot," and go back. So anyway, this I'll make sure I include this link because it's got some good stuff in here. Also talking about your base year value transfer for people who are over the age of 55 or disabled or victims of wildfire. But now let's dive in. So Kevin, he's got a strategy. So let me pull up your slides because it really was a cool way to run through it.
no.
And so one
Thank
second.
my awesome marketing team for putting this together.
Yeah. Yeah. All right. So lay it out. Tell us what's going on in this situation.
All right. So the situation, again, we're moving away from primary residence.
Yes.
This is the situation here. We have a couple who owns a vacation home in Santa Barbara that they bought 30 years ago. So we know that they bought it. It was a lot lower amount than what the property is worth now. They want to leave it to their daughter. They only have one child, so it's only child in this situation. But transferring it is going to trigger a reassessment, and they did the math, and that's going to triple the property tax if they give it to their daughter at any point, if they give it to her during life or they give it to her at their death. So a transfer is a transfer, whether it's a gift or it's a sale or it's an inheritance. It is a transfer that's here going to trigger a reassessment. In this year, we assume 2025, they've calculated the property tax is going to be triple what it is now. This really frustrates them because they want to be able to give their daughter what's not in this little write up here is we can imagine the reasons they want to give it to their daughter. Their daughter wants to buy a house, but can't buy a house because the interest rates are so high and the values are so high that she can't afford to purchase a house. But they have an extra house. They're not really using it anymore as a vacation house. They can always go visit their daughter. She's up in Santa Barbara. Why can't they just let her have that house? And that would seem to me make a lot of sense. They're thinking, well, maybe we'll wait then, and we won't gift it to her in life. Now we'll wait to gift it to her in death. The situation is that they still have a property tax problem because the property tax is going to be reassessed either way. Why? Because mom and dad are not living in the house as a primary residence. It doesn't matter that they go up to Santa Barbara every so often and stay a couple months at a time. That is not their primary residence, because you can only file one homestead exemption or on one property in the entire state. You can't have multiple. So they live in Orange County. That's their home. Their primary residence is not in Santa Barbara. So it becomes there is no exception, no exception to the reassessment rule anymore. So
Yep. And does
how,
even if she moves in, even if she moves in and makes it her primary residence, that doesn't matter because people ask me that.
yeah,
That's irrelevant. It wasn't a primary residence for the parents. That's what matters.
exactly. So the question is, how can they protect the home from an increase in property tax? Is there a strategy, or are they just the equivalent of the everlasting legal term SOL?
Or up a creek without a paddle. That one.
Not a paddle, that one too. The good news is that they are not. There is a strategy that the legal community has come together. The estate planning attorneys got together and said, you know what, this isn't right. How can we play within the rules to get to the same result at the end, which is we want to transfer the property from parents to daughter without triggering a reassessment on the property tax. And so, like with anything, with a change in the law, all that does is send the nerds to the nerdery and figure out how to come up with a new strategy to get to the same result. Unfortunately, that strategy is a little bit more complex than it was before. Obviously, the strategy before was just give it in death, not a problem, or you can give it in life, not a problem. That's easy. The strategy was file a deed or name an heir in your trust. Now, the new strategy has some more steps in it for a reason. Basically, the reasons are you have to do it. Now we have taken the original strategy, which when we had the law on our side was we can just have a quick transaction, one boom, like here, really short. Now, in order to get to the same result of transferring from the property parents to daughter, we have to elongate out that transaction over a series of a number of years. Here, when there's one child, it's 4 years. So, over a series of 4 years, we need to transfer the house through a series of 2 different limited liability companies, or LLCs, in order to get to the result. Daughter now owns the house 100%, and the county of Santa Barbara doesn't get anything more than they're already getting. So trying to lay it out just visually here, we follow parents own that second home in Santa Barbara. They then in year 1 would create an LLC number 1, and they move the house into that LLC. So their parents LLC number 1 now owns the house. At the end of year 1, beginning of year 2, they then assign half of the LLC to their daughter. So now parents and daughter own half of LLC number 1. That
Okay. I'm going to interrupt. Sorry.
Yep.
Because I got some questions and I told you I was going to bring some questions. So, the kind of a basic question that LLC number 1 holding the house, that can be within a trust. An LLC can be held in a trust, right?
Correct. Yep.
Okay, cool.
I took the trust out of the example here just to simplify.
Yeah,
Yeah.
that's all I'm going to ask on that. I'm not going to dive any deeper. I just wanted to make sure because that's part of what you do, set up this whole big thing. Then, so at this point in time, when the child is getting 50% through LLC number 1, is that does that trigger an income tax bill?
If they're renting the property to other people and they have renters living in that property, then yes, then the child is getting half the income.
Okay. So
Right.
just income. But okay. So but nothing related to, I mean, the child owns 50% of it. It's not like they've been gifted and they need to pay any taxes on that.
That's a great question. So here it depends on the transaction. Here we're assuming that it is not a sale, because we don't want a sale. Mom and dad don't
Correct.
sell the property to daughter, because that would trigger a property tax reassessment on the half the house or the entire house if they sold the house. So what it's going to be is going to be a gift. So mom and dad will have to file a gift tax return to note that gift with the IRS. Great news is the one big beautiful bill just said that everyone has $15 million of gift cards from the IRS. You just have to let the IRS know you're using a portion of your gift card, and
I love that.
most people, it's not going to be an issue, right?
Okay. All
Um,
right, I'll let you go on. Those are my two my
great,
questions. There's more coming. Be ready.
bobbing and weaving. So we're at that stage of mom and dad own one half of the LLC in year two. Daughter owns the other half of the LLC in year two. At the end of year two, beginning of year three, mom, dad, and daughter say, we don't want this LLC anymore. We're going to terminate the LLC and pull the property out to us outside of the LLC. Now it's owned 50% mom and dad and 50% daughter. To your point with the trusts, it's really 50% mom and dad's revocable trust and 50% daughter's revocable trust.
Okay.
So we avoid probate in the situation where one of they either half died. So they have to jointly own the house that way for a year. And so then at the end of year three, beginning of year four, we say, um, we're now going to create LLC number two in year four, and we're going to start that LLC 50-50 again. So that the end of year four, mom and dad then gift the remaining 50% over to daughter. And so daughter owns 100% of LLC number two. Daughter can keep it in LLC number two and just hold it that way. Or, of course, she can pull it out of LLC number two and do something else with it. Uh, Either way, the property tax is not reassessed at any point in this step process. I noticed if we just went from the beginning to the end, parents
Yeah.
second home, and we transfer it to daughter 100%, there would be a property tax reassessment. In the facts, it was triple. Um, but here, there is no property tax reassessment. So daughter owns 100% of the house and has the same property tax amount that parents had. In other words, the base valuation remains the same. So that's
Okay.
the strategy. So it takes a lot longer than it did before, and it's a little bit more complex because we have to build two LLCs and make transfers and ensure both mom and dad have revocable trusts as well.
Now, my next big question in this process, and we'll just go to the end, is there a step up in basis of the value for calculating income taxes?
Great question. And sorry to say, you do forfeit that benefit in this process. Just like you would forfeit that benefit if you gift any appreciating asset to somebody in your lifetime, you forfeit the step up, meaning
Got
that
it.
that person now has the same cost basis as you did. So this is not a strategy for everybody. This is a strategy that works best if this is a legacy property or a property in which you believe that the next generation is going to hold for a long time, or you just want to provide them the opportunity to hold it to decide whether or not to sell it or not. So if it's, hey, this is a property that there's a strong likelihood that my child or my kids are going to sell it, then this is not a strategy because you want the better benefit would be to retain a step up in basis. Who cares about the property tax if it's really not going to be an issue because they don't own the house? So that is the number one question that I ask clients when they come to me and they say, "Oh, I want to know more about the Prop 19 solution I hear you have and everything." I said, "Okay, well, let's talk about the property. What are the goals of the property here?" And we have to start there. And if it matches, yeah, if then we can talk about this strategy.
I'm down here at the where the daughter has 100% ownership,
Mhm.
and she doesn't have her step up in basis, but she could pass it on to her kids in such a way that they would get a step up in basis and also be reassessed on property taxes, correct? So that it's not stuck at that low basis from the parents forever. It could be fixed, right?
Right. So the capital gains tax problem, if you will. So now it's like, oh, we've avoided property tax, but now we've taken on a capital gains tax problem or an income tax problem here. So remember those three taxes I was talking about. The best you can do is solve two out of three. Can't get all three. You can't have your cake and eat it too on all three. You can get two out of three. And um, there was an old movie. That where one of the characters said, we still have two branches of the three branches of government. Two out of three ain't bad. And that's true. If you're two out of three and you're hitting baseball, you're in the Hall of Fame for sure. Here, it's look if things change because circumstances change. So one generation's like, this is great. We are solving the property tax problem. Wonderful. It goes to that generation like, great. We're not going to sell this thing. But now, like, oh no, it's going to be different for the next generation.
Yeah.
Now you have a capital gains tax problem. You get to solve that by gifting it to them at death, and they will get a step up in basis at that time. So that's one way. The other way, say daughter here, the idea was this is going to be a legacy house. I'm always going to live in this house in Santa Barbara. I love Santa Barbara, blah blah blah. And she lives in there for a while, and then all of a sudden she falls in love with a guy from New York, and he convinces her to move to New York. And then she's like, well, I can't just keep this house or whatever. I'm going to sell it, but I can't sell it because I have a capital gains tax problem. There are creative ways to get out of that.
Yeah.
Like we can move to New York, keep the house rented out for a couple years, and then sell it and use a 1031 exchange. So
Bingo.
yeah,
Yep. 1031 exchange. The other thing is there's a program with loss harvesting. I'm going to release more information on it. It's fascinating. One of my recent sales, that's what the seller's doing. It's interesting how death tends to solve tax problems, especially for the dead person. But anyway, stupid joke, I know. All right. So red flags to the assessor, potential issues. Dive into it.
yeah. So when I talked about elongating the process, an easy red flag to the assessor is you go through that process too quickly. You say, okay, 4 years, gosh, that's a long time. Why can't we do it faster than that? Can we do it in a year, in 2 years? The reason why we have the 4 years is that we're comfortable with at least a year in between these transitions, because the assessor is not going to flag them saying, I know what you're doing. Uh, the shorter time period, it's called a step doctrine, and that's the legal phrase. They're going to know, they're going to say, hey, we know that you're really transferring it from parents to child, and so we're going to negate all these transfers and just reassess anyway. And there is a greater likelihood that they see that on a shorter timeline than a longer timeline. Plus, there's independent arguments for why you might want to make transitions between an LLC, opening it, terminating it, and all those things. So the rushing through, so haste always makes waste. So we don't want to hasten, we want to elongate, so there's not a red flag to the assessor. Issue two is, what if someone dies during the process? So we talked about mom and dad. What happens if they die? Well, if we're in year two and they share 50-50 in the LLC, mom and dad both die at that time, then there is, sadly, there'll be a reassessment on half the property. The benefit is that, well, you saved 50% from being reassessed. An issue for the parents, though, is like, what if my daughter died? Because that's not expected, right? And that's the big unexpected event, is daughter's not going to die. But unfortunately, there's unexpected event, and she does now. And daughter's estate planning, because she's not married in my example, says it goes back to mom and dad. Well, now mom and dad own 100% of their Santa Barbara property, but they have a higher property tax than they did before they started. That would seem like, oh crap, not only did we lose our daughter, now we're paying Santa Barbara County more money for the property we owned to begin with. So typically there, I encourage clients to take out a term life insurance policy. Doesn't have to be very big, $100,000, $200,000, be very cheap and affordable on a younger person, assuming health conditions, to as a contingency to in case that situation happens. So yes, the property tax would be reassessed, but you have those death benefits to pay for the increase in property tax during the rest of their lifetime. So they're really not out of pocket anything. And then the last is, the last deal with trust. So first, we don't want anybody to pass away owning the property just in their name, or just owning it, being a member or a partial member just in their name. We need to back that up with ownership through a revocable trust at a minimum, so that where this problem is not exacerbated by the fact that, oh, now we have to probate half the property in addition to the property tax being reassessed. And the last is, well, what if my daughter has all sorts of liability issues? She's a doctor, engineer, a lawyer, and I'm worried about her getting sued. She, runs a trucking company, construction company, whatever, and she is high risk to be sued, or she's married, and I'm just worried in the future what happens if they get a divorce, those sort of things. So we can look at asset protection types of trusts instead of the revocable living trust as a way to protect this interest as we go through. So in a situation where mom and dad are in the middle of that process, again, we're at the 50-50 level, and daughter gets sued for malpractice, because again, the doctor situation, she gets sued. Half of that house is part of the asset she has to disclose, and mom and dad don't want to have to be worried about them losing the Santa Barbara house because somebody sued their daughter. So we do need to look at potentially, just as in any situation, when I talk to clients about how they want to leave assets to somebody, we have to look at the beneficiary. Does the beneficiary need protection either from themselves or from other people potentially? So we can layer on top of this strategy asset protection through trusts. So that's not, these are things that I meet with clients, and we talk about all of this. But these are things that we want to just take a look at nonetheless in any sort of situation where you're transferring assets. So the good news is, Christian, is at the end of the day, we have a solution for those clients where it makes sense that we can work through the process of getting the real estate to the next generation without, or the generation beyond that. So this works not just parent to child, like sometimes grandparents want to transfer the property to the grandkids, and the parent, it doesn't matter whether the parent's alive or not anymore. We could transfer the property to anybody, and avoid a property tax reassessment.
Okay, amazing. And what I love too are you've talked about all the layers of risk. Going back to red flags to the assessor, um, could somebody turn you in on this? Like what you're doing? I mean, is this an offense that an assessor, if they caught you doing it, would go ahead and automatically reassess you?
I mean, the number one, this is playing within the rules. So there's nothing about this. This is leveraging the property tax laws in regards to business entities. So Prop 19 did not affect the laws in regards to property tax and property tax reassessments as they relate to business entities. So we just, as a estate planning group, looked at it and said, hey, wait, there's this other way, because the law is favorable. There's still exceptions to property tax reassessments if a business owns a property. So this is all within the bounds of the rules. So it's above board. Could somebody turn you in and say, oh, you should check them out because I know what they're doing? I suppose, like somebody that doesn't like you very much can try to tattle on you, but at the end of the day, there has to be some more proof. It is still auspicious in that sense, is that they can see a transfer, but how are they going to prove intent at the end of the day?
No, that makes sense. That makes sense. And you're right. You're coloring within the lines. It's not
Yeah,
like you're doing anything here that the law doesn't currently allow. You're coloring within the lines. And
yeah.
then the timeline based on family size. Explain this, because this, in our example, is one child. It was a 4 to 5 year process. Is this to get ownership interest if there's more children across all the children? Is that how this is?
across all the children. So that
Okay.
would be, so assuming you have two kids and you wanted to get, it's a legacy property. Example, I have a couple clients that have homes in Pebble Beach, and vacation, their investment properties, vacation homes, and they make a killing when the tournament's up there and renting out to others. Uh, they want to keep those properties within the family and want the family to be able to use them, moving on to the next generations. So then they have families that have multiple children in it. So yes, those situations are they're going to leave the house to multiple children through a trust. Um, so we want to make sure that we're doing the strategy, but it takes a little bit longer because there are more people, so the fractional transfers are lower than 50% at a time, so that's why it takes a little bit longer. The more kids you have, the more kids you want to own the house at the end, right? So you can have four children, but you only want one child to get the house. It's not a 9 to 10 year process because you have 4 kids. It's a 4 to 5 year process because you're transferring it to one person.
That makes sense. Yeah, it just depends on how many people are ultimately going to have an ownership interest in the property when you're done. That makes perfect sense.
Right.
It was very helpful actually seeing the timeline and running through this. This is good stuff.
Yeah, well, I appreciate the opportunity to get it out there. It's we've been having a lot more conversations about it. In fact, one of the I think the last time I was on, one of the questions came up from a listener and a viewer, and they asked about Prop 19. They actually ended up we had a consultation about it.
Oh, nice. That's
Yeah,
good.
the whole visual is kind of an outgrowth from some of that conversation.
Yeah, no, and there's so many layers. It's that visual helps make it more palatable to understand, but still, they need to sit down with you to go through the specific scenario for the family to figure out how it would work.
Yeah, and like we were talking before, it's a numbers game. So doing at the number one thing that we do in our analysis is that we'll project out the cost savings over time, so they can see, what is their ROI on it, when is the break even year, kind of like like an insurance agent might do on a whole life policy. You can see what year you break even on your investment to what you get back. Same here. That's what we have a whole model for that, so you can calculate out what the savings would be, because that's also important. Is having these consultations is people always want to see the numbers. Well, let's crunch the numbers to see what the impact is. How much is the savings really going to be over time? And that obviously that's the cost benefit analysis. Does this make sense to do and invest in this project? Yes or no? Well, yes, because we're going to keep it for a number of years. Obviously, you calculate if you have $10,000 a year that you're going to save, over 10 years is 100 grand. So
That's it. It's the bigger the property tax reassessment will be, that's the amount of money you're saving. So the bigger that reassessment would be, the more you're going to save, and the more worthwhile this makes this, and the
absolutely.
quicker you get the return. And same thing with 1031 exchanges. What's interesting, going back to step up and basis, I talked to a lot of folks that didn't know about the step up and basis. They think they have to do a 1031, but because of a step up in basis, let's say their parent died 2 or 3 years ago, values have plateaued. You do not need to do a 1031 exchange. You don't have enough gain from when they passed to today. So you don't need to do a 1031 exchange. You can just go ahead and sell the asset. So anyway, kind of off topic, but a one that literally I feel like a couple times a month I'm having that discussion and making people happy, because 1031 exchanges are great, but it's even better just to sell the darn property without timelines. So
Yeah, absolutely.
all
There's
right, so we got some questions that came in. Thanks for everybody who was watching and listening. We dove deep. So question: can a dynasty living trust eliminate all the problems? Any thoughts on that?
yes. The answer is no. Uh, yeah,
Okay.
bluntly, the answer is no, and the reason is that dynasty trusts are great. There's a lot of benefits to them, and you can still work through a dynasty trust it's not like, hey, get rid of your dynasty trust. I'm not saying that. I'm just saying that there's still a change of ownership, beneficial ownership when it comes to dynasty trust, because once uh, the creator of the dynasty trust dies, then the next beneficial owners of the trust, they're the beneficiaries of the trust. At that point, there's a change in ownership, and the assessor will look through the trust. So they're going to see this property is held in this dynasty trust. They're going to want a copy of the trust to review the trust. And their legal nerds over there are looking at who's the beneficial owners. And they're saying, well, it's the next generation. So there's a change of ownership under the property tax code. And that will continue to happen as that generation dies off, and then the next generation of the dynasty trust goes in. And so while the dynasty trust has a lot of benefits and allows that trust to continue in perpetuity, there's no end. They're still going to trigger these change of ownerships and have property tax reassessments along the way.
That's good. I love just no. Hey, the short answer is sometimes the best. Edwin is selling a 6-unit apartment building in San Fran. Any Prop 19 consequences? So, Edwin, I wouldn't say any consequences. There'd be a consequence for your heirs if you didn't sell it. They would be reassessed, and then the new owner. Now, when you're selling it and you're still alive, the new owner is going to be reassessed for property taxes based on the sale price of the property. Anything to add to that?
Yeah, well, Edwin's concern should be capital gains. So
Yeah,
what is my liability for that, and should I be pursuing a 1031 solution?
correct. And we got to thank you on that. Yeah. No, it was a great question. I'm glad. I don't even know what a dynasty trust is. We'll have to talk about that at one of these coming up.
Yeah, you remember the show Dynasty back in the
I do. Let's go ahead and we're going to talk about choosing an attorney to set up your trust and help with estate planning. What's some good, quick advice on that, Kevin?
Number one, choose a live person, not AI or
Ah,
so live person. The So that's number one, because you want to be able to have a back and forth with a person that has the license. So chatbots don't have licenses that you want to. That's number one. Number two is you want to look at like with any professional. I always look at, well, what team surrounds that individual, because if you're working, a lot of sole practitioners out there, and this is not to say that you can't work with a sole practitioner, but you want to look at, does that sole practitioner have a team? It doesn't have to be a big team, but a team. Who's supporting that person? Because through the process, we want to understand, am I just talking with this one lawyer and everything's this one lawyer does everything, wears many hats? That you have to manage your expectations about their availability, their capacity, their bandwidth, to get the job done and get the job done well. Having a nice team to support is helpful. And for some people, it's geography from a standpoint. Do you want to go and see eye to eye, literally, with that person? Then, of course, you're going to want to choose somebody that's nearby. If that's important to walk into an office, so do they have an office near you? Or could they have one near you to do that? Or are they just fully remote? Do they have remote capabilities if you want that? So what is it that you want? The biggest thing, I think, in addition to using an actual live breathing person or firm that has breathing people in it, is the relationship. Is this a firm that is focused on relationship, or are they just focused on legal documents? Because the legal documents are only as good as that very moment. Your life is going to change. The laws are going to change. So it's a fluid thing. So your plan needs to be updated to match the circumstances in your life. It's dynamic. So if there isn't a focus on relationship, the challenges could be that something happens to you and your plan is outdated because you didn't have the relationship. So relationships are huge in my industry, in the real estate industry, with Christian, to financial advisors. anywhere you want to, that goes not just for lawyers. You want to work with professionals that are building a relationship with you and the next generation. So what's their succession plan? Because you're building this whole plan to then leave to things to the next generation. Well, who's going to help them? You're if you and if you're working with me, Christian, we're about the same age. So you're going to have a, hopefully I live a long time, but I'm not going to live as long as your kids are going to live, right? Chronologically. So what is the succession plan? Is the firm able to have a relationship with your heirs as well? So those are all important things.
That's great advice. Yeah. And going back to AI, it's very tempting to attempt to use tools like that. And the AI tools can actually be very convincing that what you're getting is what you need, but you don't know. And AI loves to hallucinate and make stuff up and maybe put some stuff in there that just isn't even real or true or work. So that's why an expert like Kevin's going to be able to figure out the plan that works for you and actually put the language together so that it will work. So,
That's right. That's right.
all right, one more question, and then we're going to say thank you. So, Edwin's got a question. Non-grantor trust sells the property. Capital gains are passed through to the four beneficiaries. Does each beneficiary get the $40,000 SALT deduction? So, capital gains and the SALT deduction are different things. I think we got a few layers here, Edwin.
Yeah, yeah. No, number one, they're different things. So
Good question. Good question.
yeah, capital gains here. If, non-grantor trust, just that language there, very specific. Grantor, non-grantor trust. Basically, non-grantor trust means that the person has gifted the property to their kids in their lifetime. So they said, hey, we're going to create a trust for our kids while we're alive, and we're going to put that property in that trust while we're still alive. So there's a trust that exists that's not our revocable living trust with our other assets. We created this whole other trust, and usually there's tax and asset protection issues that we're trying to solve there for that purpose. And so that's what this person is asking. So because it was gifted during the lifetime, the capital gains can be an issue. The same
Yeah.
reason you gift it without the trust, it could be. And so yes, the beneficiaries are going to keep the same basis as the parent had. So if the non-grantor trust sells the property, those beneficiaries will split the capital gains tax liability among them. So so they just need to know. The SALT deduction, completely different. SALT deduction deals with the property tax and any mortgage payments that they can deduct off of that. So the question is, do they get $160,000 SALT deduction because there's four beneficiaries? If that's the question, the answer is no. They only get the non-grantor trust itself gets the SALT deduction.
Good. That's a good distinction. I'm going to remember that for my landlord clients. Can't give tax or legal advice, but I can repeat what Kevin said.
Now, there's some strategies, and if you want to, with SALT deduction, you have to have multiple non-grantor trusts.
Oh, interesting. Okay, so that would be you could have set up four in Edwin's case. Going back to this, there could have been four trusts, correct?
One for each beneficiary. Right?
Yeah, and they'd each have a quarter ownership. You'd still have the capital gains pass through, although not everybody, like you can do a 1031 exchange with just your portion of the gain. I don't know if people realize that. So like if one of the kids wants to do a 1031 or two of the kids want to do a 1031, they can. Anyway, but what you said is for trusts, then each of those trusts would get that $40,000 SALT deduction.
Right, and so that has been the workaround that California and other states have allowed. And whether or not you want to pay the extra income tax, because I know Edwin's talking about state treats capital gain as ordinary income, so you can do it in California, sure, but you're going to pay the 13.3% income on the sale. The challenge that people know is you out there. So Edwin or other people that are researching online, there are other states like Nevada they don't have income tax. That people like, hey, let's create a non-grantor trust in Nevada. Well, if the property is in California, you don't get to do that. You don't get the advantage. You did before, but California caught up to that, and we were coloring in between the lines before, but California said, "Aha, we're going to pass a law that now changes the law. You can't do that." So if you have property in other states, you might be able to do something like that, and it would make sense to do that SALT deduction stacking with a non-grantor trust in a state like Nevada. But if it's in California, can't do it. But you could do for income savings, but you could still do the SALT deduction stacking thing that we just talked about for non-grantor trusts to take advantage of that deduction. So complicated stuff. Like people's heads are like,
No, this is what I love. We get in the weeds on this stuff, and this is what excites me. We're past an hour now. We're only supposed to be going an hour, but we're gonna end it. But this is why, for situations like this, you just reach out to Kevin and you have your consultation, your one-on-one. You figure out the best strategy. But I love this stuff. We'll do another discussion on these topics, and then this is a great question from MM, and that is, anything my siblings and I should do regarding our elderly mother's rental properties prior to her passing? There's so much that needs to be done. We could do an entire live stream on this topic alone, but definitely reach out to Kevin, because that's his spectacular question. Don't answer it, Kevin, because we'll be here another half hour.
right. There's so many unknowns in that, but that
Yeah, exactly. Well, that's why they consult with you. I basically, people reach out to me. I'll give them a few key points of, hey, you got to talk to a planner about this, and this, and then they come to you and they go to a CPA and get it all figured out. Well, I can't thank you enough for doing this. I know you're catching up from being out of town. Like you said, the bags under your eyes aren't too big because you're relaxed. I hope it stays that way. You've earned it, my friend. Really appreciate your time spent on here.
More than welcome. Thank you again. It's a pleasure to be on your show. You got great viewers on here, great questions, and great topics. So happy to have
you. All right. Take care. Good to see you.
Take care.